China intentionally allowed its currency to weaken to prepare for higher trade tariffs under the second Trump presidency. China is leading currency manipulation as it is one of the biggest trading partners of the US. Earlier, Trump threatened BRICS with higher tariffs on various occasions during the election campaign and even after winning the election. Now, China's top leaders and policymakers are considering allowing the yuan to further weaken in 2025, anticipating higher US trade tariffs as Donald Trump returns to the White House. The contemplated move reflects China's need for a larger economic stimulus to counter Trump's threats of punitive trade measures. Trump has announced plans to impose a 10% universal import tariffs and a 60% tariff on Chinese imports into the United States. Initially, foreign exchange markets moved on this news, but China and other BRICS countries saw it as an option to prepare to balance the trade with the US. BRICS did not try to control the falling currency and let it fall, even made it fall to prepare for a trade war. Right now, the Chinese yuan stands at about 7.33 per dollar, the Indian rupee at about 86 per dollar, and the Russian ruble at 103 per dollar. Before I proceed, I encourage you to consider liking the video and don't forget to share your views on the topic in the comment section below. Your feedback is invaluable for us and a wider audience around the world. Allowing the yuan to depreciate could make Chinese exports cheaper, mitigating the impact of tariffs and creating looser monetary settings in mainland China. This strategy is not new. China has a history of competitive devaluation to offset tariff impacts. In 2019, the US Department of the Treasury labeled the country a currency manipulator. China is the second largest economy in the world and the biggest manufacturing hub, and that's why China is the biggest trading partner for so many countries. China-sensitive currencies such as the South Korean won, the New Zealand dollar, and the Australian dollar touched a one-year low. Financial News, People's Bank of China publication, released an article stating that the foundation for a basically stable yuan exchange rate remains solid, and the yuan is likely to stabilize and strengthen towards the end of this year. Allowing the yuan to depreciate in 2025 would deviate from the usual practice of maintaining a stable foreign exchange rate. While the central bank is unlikely to state it will no longer uphold the currency, it will emphasize giving markets more power in deciding the yuan's value in 2025. During Trump's first term, the yuan weakened more than 12% against the dollar amid tit-for-tat tariff announcements between March 2018 and May 2020. A weaker yuan could help China's economy achieve its challenging 5% growth target and relieve deflationary pressures by boosting export earnings and making imported goods more expensive. Economist Fred Newman said, "To be fair, it is a policy option. Currently, adjustments are on the table as a tool to mitigate the effects of tariffs." However, he cautioned that aggressive currency devaluation could lead to a tariff cascade as other nations impose import restrictions on Chinese goods in response. Analysts forecast the yuan to fall to 7.5 per dollar by the end of year, though much depends on the extent and speed of Trump's tariff increases. The currency has lost nearly 4% of its value against the dollar since the end of September as investors prepare for a Trump presidency. The onshore yuan weakened past a level that China had been defending throughout December, opening up room for the managed currency to drop further amid a sluggish economy. The yuan breached the psychological milestone of 7.3 per dollar for the first time since late 2023 amid concerns over China's economic struggles and a widening bond yield discount to the US. The move came even as the central bank maintained its support for the currency with its daily reference rate. However, some experts raised the concerns of weakening the currency. Fred Newman, chief Asia economist, HSBC Hong Kong, said, "Currency adjustments are on the table as a tool to be used to mitigate the effects of tariffs. I think that is clear. It's tempting to think that Chinese currency weakness could fully offset US tariffs and neutralize the impact on the economy, but I think that would be short-sighted. The Chinese leadership is likely also to be mindful about the impact of a weaker Chinese currency on other trading partners. He added, if China takes the currency aggressively lower, it raises the risk of a tariff cascade. So I think there is a bit of a risk here that if China uses its currency angle too aggressively, it could lead to a backlash among other trading partners, and that's not in the interest of China. Ling Song, chief economist for Greater China ING Hong Kong, said, this sort of mild depreciation is still well within expectations, given an expected stronger dollar backdrop. There is some voices in markets calling for a quick 10 to 20% depreciation to help offset tariffs. We don't expect an intentional and sharp depreciation like this. Rapid movement abandoning the currency stability objective would also unwind the progress made over the last few years on maintaining Chinese purchasing power, reducing capital outflow pressure, and improving the yuan's role as a settlement currency. Jin Moteki, currency strategist Nomura Securities Tokyo, said, even if the Chinese yuan depreciates to some extent because of Trump's tariffs, I think the yen is unlikely to move in the same direction. I think maybe if the Chinese government allows yuan to depreciate, it will support Chinese exports. So in this sense, in terms of the demand supply and balance, the yuan is supported by the improvement in the Chinese trade balance. Ken Chuang, forex strategist Mizuho Hong Kong, said, if currency depreciation served as a tactic to counter the tariff shock, the likely escalating trade war could reinforce US dollar exceptionalism and weigh on regional currencies. Yuan depreciation to 7.5 will remain manageable on the capital outflow risk, especially with forex stabilizing tools in play to manage depreciation pace and magnitude. Charu Chenana, chief investment strategist at Saxo Singapore, said, China appears increasingly anxious about the impending Trump presidency, as indicated by recent stimulus announcements and reports on the yuan depreciation. However, these measures do little to tackle China's fundamental debt issues and the lack of confidence among consumers and businesses. In fact, a weaker yuan exacerbates these problems and poses the risk of China being labeled a currency manipulator by the US Treasury. On January 3rd, the People's Bank of China allowed the yuan to depreciate beyond the key threshold of 7.3 against the US dollar. This move triggered ripple effects across global markets, fueling uncertainty. Thank you for watching, and don't forget to subscribe to our channel for new videos on important international topics.